So you've decided to buy a property, but what mortgage product do you choose? In this video, I'll be discussing fixed rate mortgages along with some forms of variable rate mortgages. So first up, fixed rate mortgages. A fixed interest rate simply means that the interest rate that you have for your mortgage product will be fixed for that initial period. This fixed period can be different depending on your preferences, but it's generally either 2, 3, 5, 7, 10 or 15 years. A fixed interest rate might be most suitable if you just want the assurance that your monthly payments will remain the same throughout that initial period. This will allow you to budget accordingly, because if the rate is remaining unchanged, so your monthly payments are remaining unchanged, then you know exactly what your outgoings are for your mortgage month on month. And you'll also have the peace of mind that if interest rates did increase, then you will be safeguarded against that because you've fixed your interest rate. So what are the cons then for a fixed rate mortgage? Well, firstly, most fixed rate mortgages will come with early repayment charges. You'll want to check the small print in your illustration and your mortgage offer just to run over these details, but your broker will tell you when they recommend the product what these early repayment charges are. So to give you an example, if you fixed in for your interest rate for 5 years, but you wanted to pay off your mortgage early in the 3rd year, or you wanted to move home, then you may be facing early repayment charges. This will generally be a percentage of the loan amount. So say for example, if it was 3% of the outstanding balance, you may find that this early repayment charge is quite hefty. Another downside to a fixed interest rate mortgage is that if rates do decrease, then you won't see the benefit of that because you're fixed in at that higher rate. So is there anything else that you should consider when you're looking to arrange a fixed interest rate mortgage? Well, the length of time that you actually fix in for is going to be dependent on various factors. So it's important that you talk it through with your broker just to make sure that you are fixing in for the right period if you are choosing to go for a fixed rate mortgage. For example, one of these factors will be how long you see yourself living in the property for. Because if you only see yourself living there for 2 years, then you might not want to fix for 5 years or 10 years, for example, just to avoid those early repayment charges. If you do find yourself in the situation where you are fixed in at that interest rate, but you do really want to move home, then it doesn't necessarily mean that you will definitely need to pay this early repayment charge. There might be an option available to you known as porting your mortgage, which is generally acceptable to many lenders at the moment. This is simply where you would move your existing mortgage over to the new property and then taking out any top-up loan where needed with the same lender for the new purchase. And where you're moving this mortgage from one property to another, it's not the same as repaying the loan, so you won't have these early repayment charges applicable. It's just best to check all of the paperwork and the fine print just to make sure that you are able to port your mortgage if you're looking at a fixed mortgage product. If you'd like some further information on porting a mortgage, I have made a separate video on this, which I will link in the description below. That being said, there may be some more flexible fixed mortgage products available to you. You may be able to arrange a fixed mortgage interest rate with no early repayment charges, for example. Or you could look at options such as an offset mortgage, where you can generally lower the amount of interest paid overall on your mortgage. Again, if you'd want more information on what an offset mortgage is, we have also made a video on that, and I'll link that below as well. So now we're going to talk a bit about variable interest rates. The main types of variable mortgages that we're going to discuss today are tracker rates, discount rates, capped rates, and standard variable rates. So, tracker rates. Well, tracker rates track the Bank of England base rate. The main potential advantage here is that if the Bank of England lower the base rate, then you will benefit from a lower interest rate. But do be careful to check if there is a collar set on the interest rate that you have, or potentially a little bit lower, because they can cap the amount that you benefit from this rate. Another advantage of a tracker rate is that some of these have no early repayment charges. So they're a lot more flexible than most fixed rates, because if you wanted to pay off chunks of your mortgage, or you weren't sure when you wanted to move home, this could be a suitable interest rate for you. You may also find that tracker rates are lower than fixed interest rates, because with fixed rates, you've got that protection if they were to increase their interest rates. In terms of downsides to a tracker rate mortgage, the main one when you're comparing this to a fixed rate mortgage is that if the Bank of England increase their base rate, then your interest rate will increase as well. So you've got less of a safety net there available to you. Another downside with some tracker rate mortgages is that you might find, similarly with the fixed rate mortgages, that there are early repayment charges applicable. So always make sure that you know what the product is that you're looking to secure inside out before making that final decision. So now we're on to discount rate mortgages. This is an interest rate that is discounted against the lender's standard variable rate. Although a lender's standard variable rate might be influenced by the Bank of England's base rate, they aren't directly linked. The lender's standard variable rate is at the discretion of the lender. One thing to quickly point out with discount rates is that don't automatically assume that if you're getting a larger discount with one particular lender, that means that's the best deal that's available. Different lenders have different standard variable rates. So a larger discount with one lender who has a higher interest rate might not be as good of a deal as a lower discount with a lender that has a lower standard variable rate. So just try to factor this in to your decision making. In terms of the pros with a discount rate mortgage is that you can benefit from lower monthly payments if the lender decreases their standard variable rate. And like the tracker rate mortgages, you may find that discount rates are slightly lower than your fixed interest rate mortgages. In terms of the downsides, the main one is generally that you've just got that uncertainty, similar to a tracker rate, that your monthly payments can go up as well as down. And when comparing discount rates to tracker rates, the lender can make the decision to increase their standard variable rate at any time, whereas the Bank of England only generally raise or decrease the base rate when there's larger economic factors involved. So now on to capped rate mortgages. Capped interest rates move in line with the lender's standard variable rate, but it is capped at an upper limit. So your monthly payments and your interest rate will only rise to a certain level. The advantages of this type of interest rate when compared to a tracker rate and a discount rate is that you have got the assurance of that upper limit. Whereas the tracker rates and discount rates, they can increase with no cap at the top. But you would also have the opportunity to benefit from any reductions in the lender's standard variable rate. You'll just want to make sure that the monthly payments at that capped rate are still affordable to you. The disadvantages of this type of rate is that the rates can increase at any time. So you've got less certainty than when you're looking at a fixed rate mortgage. The interest rates can also be higher than other types of variable rates, so your tracker and your discount rates. And these types of interest rates are a lot rarer to come across than other types of variable rates, such as your tracker and your discounts. So lastly, we're going to look at standard variable rates. A standard variable rate is generally associated with the follow-on rate after the initial period of one of the interest rates that we've mentioned previously. Changes made to this standard variable rate are completely at the discretion of the lender, so your interest rate and therefore monthly payments can increase or decrease at any time. And there are generally no tie-ins to this type of interest rate, so you can pay off the mortgage in full or remortgage at any time and have no early repayment charges applicable. Usually you'd find that you'd be better off switching from the standard variable rate onto one of the other interest rates that we've mentioned above. If you are sitting on the standard variable rate at the moment, then I would strongly recommend that you speak to your mortgage broker and look into your remortgage options. So there you have it. We've gone through fixed rates and some types of variable rate mortgages with some pros and cons of each. There's no one size fits all when it comes to choosing a mortgage product. It's always going to come down to your individual needs and preferences. It's best to speak to your broker in detail about your circumstances and what you're looking for, just to make sure that you make the right decision. Before I let you go, I must tell you that as a mortgage is secured against your home, it may be repossessed if you don't keep up the mortgage repayments. If you'd like any further information at all, then we've got lots of videos available and my contact details will always be in the description below. I will see you guys in the next one.